Hey guys, this is Bruce Marshall from Simpler Trading, and I wanted to put together a real short video on how to hedge trades. We are in a extremely volatile market, extremely crazy moves that we're having back and forth, whipsaws with geopolitical things going on, inflation, the Fed, China, COVID, all that. This has been going on for a little while, but I continuously get questions about hedging and how to hedge and all that, so I want to do a quick video. So let's jump right in and see what we got. I put this together, again, it's very short, but here's what we're going to cover. What is hedging, why I like to hedge, benefits of hedging, how to hedge, and then we're going to look at some examples. So hopefully this will help you and give you an edge. When you are trading, you really need to have an edge in order to take a trade, honestly. So let's jump right in. So what is hedging? If you're not familiar with it, hedging is simply being able to take trades or place trades that take advantage of a move against you, right? So we're going to show some examples. It can be on the upside, can be on the downside, but basically what this means is just to give you protection. You're trying to protect a position, a stock position or a portfolio or something like that, and give yourself some protection in the event that the market goes against you. So why do I love to hedge so much? I do it all the time. I'm always doing little like trailing hedges, and there's a difference in opportunistic hedging and black swan kind of hedging. I do both, but again, we'll get into that in a second. But hedging is very important, as you probably know, mainly to protect a portfolio. If you've got an IRA or a big account or any size account you're trying to protect, you can do that by hedging, and we want to do it in the least expensive or the most cost-efficient manner that we can. And we also want to be able to, if we're not hedging a portfolio and we just want to take advantage of a big move, say we're 100% in cash and we just think the market's going to sell off or rip higher, well, we can take advantage of a big move down or a big move up. Now, a lot of people don't think about hedging on the upside, but we get crazy moves to the upside from short covering or news driven, things like that. So always be aware that that is an alternative for you as well. During these crazy market conditions we have whipsaws, back and forth, even intraday. It's really important to try to protect your portfolio or be able to take advantage of those swings when you can, and to be able to understand all of your options and your choices in doing that, so that you get the most bang for your buck, the most cost-effective way to do it. So the biggest benefit of hedging, of course, is take advantage of market sell-offs. That's typically what we think about. And typically, what I'm most concerned with through my trading career of 33 years has been to protect a portfolio. You've got long stock positions and they're bullish, and you want to have some exposure on the downside in case things go wrong or we get some crazy news or something like that. Again, that's the traditional hedging. And again, we want to try to do that in the most cost-effective way that we can. The other benefit, and I probably do more of this lately, especially in the last couple of years since COVID, is to make a profit, honestly. Position ourselves to take advantage of a big move if it happens, and you can do that for pennies on the dollar in a lot of cases. And again, you kind of can do a twofold thing in that you can have a net on the downside. If we get a big flush down, you can make some money. Also, at the same time, can protect a portfolio if you are long. So again, several ways to do this and a lot of variations. So how do we actually hedge? Well, depending on what level you are and how you want to do it, I like trading volatility. You can do that through trading the VIX or trade volatility through some of the indexes like the SPX, the NDX, the RUT, and you do that by the Vega exposure, and you can do it by the gamma as well, but that's getting into the Greeks. We don't have time to get into all that right now. But you can trade the volatility aspect because we know when the market sells off, volatility spikes up. And I'm talking about the VIX, the VIX, right? The implied volatility of the options themselves make them a lot more expensive. And then you can trade that when they're pumped up in price. Say an option is normally $2 and a big move happens, volatility spikes up, that $2 option goes to $6. Well, you can take advantage of that, right? That's one way to do it. Another way is to hedge individual stock positions. In other words, let's say I've got a trade in Home Depot, Walmart, Target, doesn't matter. I'm just picking a name, Amazon, doesn't matter. We can hedge that specific position by maybe buying a put debit spread or something like that, and try to protect that specific position outside of an entire portfolio, right? The third one right here, hedge with indexes. This is probably the most common. This is what I do most often. And again, this is talking about the SPX, the NDX, the RUT. You could also use the SPY. You could use the IWM for the RUT. You could use the Qs, QQQ, and hedge with that. Now, what that does is gives you a larger net to throw, and in the S&P 500 case, the SPX, that gives you probably one of the largest representations of the overall market. And it's easy to watch pricing on the SPX through the ES, for example, or the SPX itself, or the SPY. And in that way, by doing that, you can catch, the big moves, not stock-specific moves like Amazon goes up or down, but the entire market goes up or down, right? So that's hedging with indexes. And another way, I do this a lot, is hedging with stock, and people don't usually think about that. It's a little more expensive to do, but it's very effective way to do it. And in other words, how you do that is if you have an option position, let's say a butterfly or whatever our position is, and it's bullish, and the market goes down, the position goes down, you can actually short stock against, to oppose that position, so that you're making money on the stock as it goes down while you're losing money on the bullish trade on the upside, right? And vice versa. If you're short something, for example, if you think Tesla, pick a name, Tesla is going to miss earnings and the stock's going to go down, and maybe you're short Tesla and they crush it and the stock starts going up, you can buy long stock to offset that as well. Again, that's not typically what people think about initially, but it's a good way to do it. And it is there's a lot of advantages of doing that, and then there's a lot of other ways to do it. I'm just kind of skimming the surface right now, but I wanted to give you some examples. And what we would look for in hedging would be, for example, these are the most common things I would look for, would be long puts. I think that's what normally most people think about. So again, long puts are probably the most common things when people talk about hedging. That's your kind of go-to strategy. I've got an example that we're going to look at. Butterfly is a very effective way to do it. It gives you a lot of bang for the buck. It's a little more, you have to be a little more precise on your timing and your entry and all that kind of stuff. So that is definitely a good way to do it. A broken wing butterfly is even better because you can take some risk off of one side or the other. And lastly, calendars or diagonals. Now, this is not at all the complete list of hedging examples, but these are probably the most common. And I'll show you, we'll go through and I'll show you some examples that I've got. So this is example number one. This is a long put, if I can write. All right, long put right here. This is a 4100 put going out to 18th of March. And it's expensive. Look at that. It's pretty expensive. That's okay, because if we go down and, again, geopolitical tensions or whatever the case is that you are thinking, have to have a theory about why you want to put a hedge on the downside, or put in this case, right? So you have to have a reason why you want to do it. You have to have a time frame. Is it going to happen in the next 2 weeks or 2 months, or are you just looking for something by the end of the year, or whatever? So you have to kind of narrow it, start in the big picture and kind of narrow it down. But here's the cool thing. This is on Toss, Think or Swim, if you've never seen this before. Again, this is kind of expensive. You can do one contract or 100, it doesn't matter, but check this out. If you were to do this, now that's 10 contracts at $58, that's pretty expensive. It's $58,000, and I probably should have just done one. But to show you, if you're trading a really large portfolio, you would do something like this. And if we went down, there's 100,000, 200,000, 300. There's a $500,000 if we got down to that level right there. That's a lot of bang for the buck, right? And you see the pink line is where we are today. The green line is where we are at expiration on 18th of March. So anywhere on this line, you are, again, there's 100,000, there's 200, that's profit, right? 300, 400, all the way up to like $700,000, $800,000 if we were to really start going down here. That's typically what people think about. And the cool thing that I used to do on the professional side or the institutional side was to, if I buy this, and I would go out further, and let's say maybe go to September with this, and then I would sell something against it to kind of offset that cost. So if I paid $58, I sell something for $30, now I got $28 cost in it, that kind of thing. And do that on shorter time, so sell May and buy September, something like that, or you can do a diagonal or whatever. But anyway, just to give you some ideas, we're going to talk about some more of these, but you're always welcome, and I encourage you to join us at Simpler Trading if you want to get your feet wet and see how this is done in real time with real money, right? So anyway, that's the long put version. The next one would be a simple regular butterfly. We talked about that of the 4 types of examples. And check this out. So this is 4,200 right now. Depending on when you're watching this video, we're at 4,290. Crazy to think we were at 4,800 not very long ago at all. So these kind of hedges have been, been crushing it on the downside, been making a lot of money here. So check this out. This one is going for $1.20, 10 contracts. So that's $1,200 of cost. And if we go down here by, in this example, on the 4th of March, look at this. There's $20,000 of profit in there. There's more than that up here at the peak of this butterfly, max profit. And anywhere in here, you're making money too. There's $10,000 here. Let's split that in half. There's $5,000 there. So anywhere in here, we're making money, right? And that's the name of the game. And again, in this kind of example, we would be thinking that we're going to end up somewhere between this line and this line at the end of the trade. But the beauty of a trade like this is, see that pink line, purple line? That line actually comes up like that. So you make money before you enter the body of the trade, and you make money as you exit on the downside. So it's a giant net that we're throwing to catch money. All we have to do is have the market go down, right? And we're just standing there with our baseball glove open, waiting on the the fly ball to come into our glove, right? And it's a cool way to do it. So that's a regular butterfly. The next way is a broken wing butterfly, and I put this one on the upside because, again, you can hedge on the upside too, right? We get a big short cover and rip higher here. This is $5. We actually did this trade in a trade service that I run called Bias, which is Bruce's income accumulation service. And so this is, we have $500, actually $505 of risk on this trade. If we end up here at the end of the trade, which is on 11 March, we make $6,000 on $500 of risk. That's pretty good, right? And that's what you want. That's what you want from a hedge trade. You want a little risk with a big reward on the other side if it indeed works. And again, we're on this is just a bullish trade, and we've got our net up here. This is a big giant net we've cast, and we're trying to catch some fish. I live on an island, so all my analogies tend to be island and sailing and that kind of stuff. So anyway, so we're casting a line out here. We're throwing a big net. Anything up here on the upside, we make money on. And as you can see, this little purple line starts arching up, and you make money all along the way here. So in other words, if you don't get to here, you still can make money here or over here. So that's a broken wing butterfly. The last one is a trade I have this trade on right now. Actually, this is in our trade service Bias. Have this on. This is a really cool trade. This is a diagonal trade. It's a put diagonal trade. This expires on 11 March. And check this out. We paid 70 cents for this trade. We did 3 contracts. So that's 7 times 300 is $210 of cost if we go up here and we're wrong. So we lose $210, and we would defend it. We wouldn't lose that anyway, but that's the setup of the trade. If we end up down here anywhere around 11 March, guess what we make? $10,000. So we're risking 200 to potentially, I mean, that's a max profit. And, you know, honestly, it's you don't get the max profit every time, of course. But all I'm trying to do is to get somewhere between, let's say, 4,200 and say 4,000. I mean, you know, that gives us 200 point, this is SPX, that gives us 200 point wide net that we're throwing out in the water there, right? So all we got to do is go down, right? That's the type trades I like to do from a hedging standpoint. Now you can do all kind of other variations, and you could do debit spreads or even credit spreads or whatever. Straddles, strangles, that's more into black swan kind of stuff, but now it's not the time to do that. You really want to do that when volatility is a lot lower for many reasons. But again, this gives you some ideas to work with and to kind of get the wheels turning. I know if you're doing any kind of trading at all, or even if you're not trading, you're investing, and you have some Microsoft in your portfolio, or some Target, or some Lockheed Martin, or whatever it is, you know, it doesn't matter, Amazon, Google, Tesla, whatever, and you want to have some hedge on the downside, any one of these type trades would work, or variations of these trades would work. I did them all in the SPX, so they're all the same vehicle. But again, we could use, if you've got Microsoft and Google and Amazon and Apple, then you're going to want to hedge with the QQQ or the NASDAQ, the NDX, right? Because that's what's going to be most closely aligned to your type of portfolio. So, and to get a lot deeper, if you really want to join me, you know, come to Simpler and join me in Bias, and we talk about beta weighting and looking at, you know, a lot deeper into this, looking at the Greeks and all that kind of stuff. But that's for another day, another topic. So I wanted to give you guys and gals just some, you know, a high level kind of look at things in order to help you get an edge, because I know in these kind of markets it can be frustrating. You get on the wrong side of the market very easily. You sleep much better at night if you have some hedge on the downside or the upside. That way, if you get a move in the middle of the night, like we had with this Russian-Ukraine stuff, you know, and the market goes down 120 points overnight or whatever, you wake up in the middle of the night and you go, oh, I'm fine, I've got a hedge on, I can go back to sleep, right? No problem. So that's what I want. I want to make your trading life easier. I want to help you get an edge. You need an edge in trading. Come join me and the gang at Simpler Trading. We have a lot of good traders, and join me in the Bias service. So again, I hope this helps you understand a bit more about hedging and how to get an edge, how to make your trading life a little less stressful, a little easier. If you like what you see, obviously like and comment down below. You guys know the drill. Let me know what you want to see. We'll do more videos. I'll keep them coming. Just let me know what you want to talk about. If you have questions, you can reach me at Simpler Trading. And again, hope this helps, and hope to see you soon. Thanks for the time.
Without Simpler Trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency. It's one of the things that won me